$3,500 per ounce. Gold just shattered every record in history. March 2026. But here's what caught my attention. While headlines celebrate new highs, central banks are buying at rates not seen in 50 years. China added 225 tons in 2025. Russia accumulated 180 tons. India, Turkey, Poland, all buying aggressively. And I keep asking myself one question. If fiat currencies are stable, if the financial system is sound, if government debt is manageable, why are the world's most powerful institutions converting paper into metal at record pace? My theory is this. They see something coming that the market hasn't priced in yet. And the pattern I've been studying suggests we're not at the end of gold's rise. We're at the beginning. Let me show you why. I'm not a financial advisor. This isn't financial advice. This is pattern analysis based on central bank behavior, monetary policy data, and historical precedent. And what I've found suggests gold's move isn't a temporary spike driven by speculation. It's a structural shift driven by institutional recognition that the monetary system is changing. And once you see the pattern, you understand. This isn't about gold going up. This is about currencies losing trust. Let me give you the framework first. Because this pattern has played out before, 3 times in modern history, and every time the same sequence unfolded. Stage 1 is stability. Fiat currencies function smoothly. Inflation is controlled. Debt is manageable. Central banks maintain credibility. Gold trades in a narrow range because there's no reason to flee to alternatives. Trust in the system is high. Stage 1 can last decades. It's comfortable. It's predictable. And everyone assumes it's permanent. Stage 2 is accumulation. Quietly, without fanfare, central banks and institutions begin converting reserves from currencies to gold. The public doesn't notice because prices are still relatively stable. But if you track physical flows, something is shifting. Large buyers are positioning, not for profit, for protection. Stage 2 is the smart money recognizing the system is becoming fragile before the market does. This phase can last years, and most people miss it entirely because prices haven't moved dramatically yet. Stage 3 is acceleration. Gold prices break out. New records are set. Retail investors start paying attention. Media coverage increases. But here's the critical part. The institutional buyers aren't selling. They're still accumulating. The price rise isn't driven by speculation. It's driven by structural demand meeting limited supply. And once this phase begins, it tends to last years, not months. Stage 3 is when the market recognizes what institutions already knew. The currency system is under pressure, and alternatives are needed. Stage 4 is dislocation. Currency crises emerge. Inflation accelerates beyond control. Bond markets destabilize. And gold doesn't just rise. It surges in ways that seem disconnected from fundamentals because it's no longer an investment. It's an escape mechanism. Stage 4 is when the monetary system breaks, and gold becomes the last store of value that maintains trust. We're not there yet, but the pattern suggests we're deep in Stage 3, and Stage 4 is visible on the horizon. Now let me prove this pattern to you using historical examples, and then I'll show you why 2026 looks like Stage 3 acceleration. Example 1. The 1970s. In 1971, President Nixon closed the gold window. The dollar was no longer backed by gold. It became pure fiat currency. Initially, the market didn't panic. Gold was $35 per ounce in 1971. By 1974, it was $195. That's Stage 2 accumulation. Central banks and informed investors were positioning. Then Stage 3 kicked in. By 1980, gold hit $850 per ounce. That's a 24x increase in 9 years. Why? Because inflation surged. The dollar lost purchasing power, and people fled to the only asset that couldn't be printed. The pattern was clear. monetary system instability, institutional accumulation, price acceleration, and massive wealth preservation for those who positioned early. Example 2. The 2000s. In 2001, gold was trading around $275 per ounce. Nobody cared about gold. Stocks were the only game. But quietly, central banks stopped selling and started buying. That was stage 2. By 2008, when the financial crisis hit, gold was at $900. By 2011, it reached $1,900. That's nearly 7x in 10 years. What drove it? Quantitative easing, zero interest rates, currency debasement, and the recognition that the 2008 bailouts didn't fix the system. They just delayed the crisis. Once again, the pattern held. System stress, institutional positioning, price acceleration. Example 3. The post-2015 period. After gold peaked in 2011, it corrected for 4 years, bottoming around $1,050 in late 2015. Most investors gave up. Gold is dead. It doesn't work in modern markets. But what were central banks doing? Buying. Aggressively. By 2019, central bank gold purchases hit the highest levels since 1971. That was stage 2 accumulation. Then COVID hit. Massive stimulus, historic money printing, and gold went from $1,500 in early 2020 to $2,070 by August 2020. Now in March 2026, it's at $3,500. The pattern is repeating. Again, and the acceleration is intensifying. 3 examples. Same 4-stage pattern, same outcome. Institutional buyers position before the public understands what's happening. Prices accelerate once the monetary stress becomes visible. And the people who saw the pattern early preserved and grew wealth. Everyone else wondered how they missed it. Now let me show you what's happening right now, and why I think we're in stage 3 acceleration, heading towards stage 4 dislocation. First, central bank behavior. According to World Gold Council data, central banks purchased over 1,000 tons of gold in 2022, the highest in 50 years. In 2023, they added another 1,037 tons. In 2024, approximately 1,045 tons. And 2025 data suggests the pace has accelerated further. This isn't temporary. This is structural repositioning. And here's what concerns me. The largest buyers are non-Western central banks: China, Russia, India, Turkey, Brazil. These nations are actively diversifying away from dollar reserves. Not because of politics, because of monetary risk. They're watching US debt levels. They're watching deficits, and they're hedging. Second, U.S. fiscal trajectory. The federal deficit for fiscal year 2025 was approximately $1.78 trillion. The national debt is now $38.7 trillion. Interest payments exceed $1 trillion annually. And here's the mechanism that matters. To service this debt, the government has 2 options: tax increases or more borrowing. Tax increases are politically impossible, so more borrowing. And who buys the debt? Increasingly, the Federal Reserve. That's monetary financing, that's money printing, and that's currency debasement. The more debt that gets monetized, the less each dollar is worth. And central banks watching this know exactly what it means. The dollar's purchasing power is eroding structurally, and alternatives are needed. Third, inflation versus real purchasing power. Official CPI data shows inflation moderating, around 2.9% for 2024. But when I look at real costs, housing, food, energy, healthcare, people are paying significantly more than they were 5 years ago. Wages have risen, but not as much as costs. Real purchasing power is declining. And this is where gold functions differently than most people understand. Gold isn't just an inflation hedge, it's a currency debasement hedge. Even if official inflation is low, if currency supply is expanding faster than economic growth, purchasing power erodes, and gold captures that erosion. Right now, M2 money supply is substantially higher than pre-2020 levels. Economic growth hasn't kept pace. That's structural debasement. And that's why gold is rising even when official inflation appears controlled. Fourth, interest rate policy. The Federal Reserve held rates high through 2024 and early 2025 to combat inflation. Higher rates traditionally pressure gold because gold doesn't pay interest. But here's what I'm noticing. Gold has been rising despite higher rates. That tells me the demand driver isn't interest rate differentials. It's structural monetary concern. And if the Fed starts cutting rates, as many expect in late 2025 or 2026, gold has additional tailwinds. Lower rates make non-yielding assets more attractive. And if rate cuts coincide with renewed concerns about currency stability, gold accelerates further. Fifth, geopolitical risk premium. Ongoing conflicts, trade tensions, and shifting global power dynamics create uncertainty, and uncertainty drives safe haven demand. But here's the deeper mechanism. Geopolitical instability often leads to sanctions, currency restrictions, and trade disruptions. In that environment, holding reserves in another country's currency carries counterparty risk. Gold has no counterparty risk. It's neutral. It's universally accepted. And that's why central banks are increasingly preferring gold over foreign currency reserves. This isn't temporary. This is structural repositioning for a multipolar world where currency trust is fragmented. Now let me show you the institutional versus retail dynamic, because this is critical for understanding where we are in the cycle. In 2020-2021, retail investors poured into gold ETFs. GLD, the largest gold ETF, saw record inflows. That was retail FOMO. Prices spiked to $2,070, then corrected as retail exited. But from 2022 onward, something different happened. Retail flows slowed, but prices kept rising. Why? Because institutional and central bank buying continued. That's the signature of stage 3. Institutional accumulation sustains price momentum, even without retail participation. And when retail does come back, which typically happens in stage 4, that's when prices go parabolic. Here's what concerns me about silver. Silver has historically tracked gold, but with higher volatility. The gold to silver ratio, which measures how many ounces of silver equal 1 ounce of gold, is currently around 90-1. The historical average is closer to 60-1. If that ratio normalizes and gold is at $3,500, silver should be at $58. Currently, silver trades around $38. That's 50% upside just from ratio reversion. But here's the additional factor. Silver has industrial demand that gold doesn't. Solar panels, electronics, electric vehicles. If investment flows into silver accelerate while industrial demand remains strong, the move could be more explosive than gold. I'm not recommending anything. I'm just noting the mathematical setup. Now let me compare current conditions to prior gold bull markets. In the 1970s, the trigger was Nixon closing the gold window and the subsequent inflation crisis. In the 2000s, it was the financial crisis and quantitative easing. Both were responses to specific events. But in 2025-2026, the drivers are multiple and structural. Persistent deficits, historic debt levels, geopolitical fragmentation, central bank diversification, currency debasement. It's not one crisis. It's the culmination of decades of monetary expansion without structural reform. And that's why I think this cycle could be larger and longer than prior ones. The fundamentals aren't temporary, they're systemic. Here's the data that keeps me up at night. Total global debt is now estimated at over $300 trillion. That's approximately 340% of global GDP. In the 1970s, debt to GDP was around 150%. In 2008, it was roughly 280%. We're at historic extremes. And servicing that debt requires low interest rates and continued monetary expansion. But low rates create inflation risk, and monetary expansion creates currency debasement. It's a trap. There's no policy path that resolves this without pain. Either rates stay low and currency debasement accelerates, or rates go high and debt becomes unsustainable. Either way, gold benefits. Because in both scenarios, currency trust erodes. Now let me walk through the mechanism of how Stage 4 dislocation actually unfolds. Because understanding this matters for positioning. Stage 4 doesn't start with gold spiking to $10,000 overnight. It starts with currency instability. A country experiences a debt crisis, or inflation surges beyond control, or a major bond market destabilizes. Initially, it's one country, one currency. But because the global financial system is interconnected, stress in one area spreads. Capital flees from the stressed currency into perceived safe havens. Gold is one of those havens. Prices rise. Other central banks notice. They increase their own gold buying to protect reserves. That creates additional demand. Prices rise further. At some point, retail investors notice gold hitting new records consistently. FOMO kicks in. Retail flows accelerate. And that's when prices go parabolic. Not because fundamentals changed, but because psychology shifted from skepticism to panic buying. Here's what I think the timeline looks like. Not a prediction, a pattern-based scenario. 2026, continued central bank buying. Geopolitical tensions remain elevated. Fiscal deficits persist. Gold grinds higher, testing $3,800 to $4,000. Retail participation increases but isn't dominant yet. This is late stage 3. 2027, a catalyst emerges. Could be a sovereign debt crisis, could be a currency devaluation, could be a major geopolitical event. Whatever it is, it accelerates institutional concern. Gold breaks $4,500. Silver surges past $60. Retail FOMO intensifies. This is early stage 4. 2028-2029. If the catalyst expands into broader monetary instability, gold targets $5,000 to $7,000 become plausible. Not because of speculation, because currencies are losing trust at scale, and alternatives are limited. Now, I'm not saying this timeline is guaranteed. I'm saying this is how the pattern has unfolded historically. The specific dates are less important than the sequence. Institutional accumulation, price acceleration, catalyst event, dislocation. And understanding where we are in that sequence matters for positioning. Here's the long-term structural thesis. And this is the most important part. Gold's rise isn't about gold becoming more valuable. It's about currencies becoming less trustworthy. For 50 years, the global monetary system has operated on the assumption that fiat currencies backed by government credibility are stable stores of value. That assumption is breaking, not because of conspiracy, because of math. You cannot run persistent deficits, accumulate unprecedented debt, and expand money supply indefinitely without consequences. Eventually, purchasing power erodes, trust declines, and people seek alternatives. Gold is the oldest, most liquid, most universally accepted alternative. That's why central banks are buying. That's why prices are rising. And that's why this move is structural, not speculative. Here's what I'm not saying. I'm not saying the dollar collapses tomorrow. I'm not saying the financial system implodes next week. I'm not saying fiat currencies disappear. What I'm saying is trust in paper currencies is declining gradually, and gold is capturing that trust erosion. It's a slow motion shift, not a sudden crisis, but the direction is clear. And the people who recognize this early are positioning. The people who don't will watch wealth preservation opportunities pass by. Let me show you one more historical parallel, and this one connects all the pieces. In the late 1960s, the US was running deficits to fund the Vietnam War and Great Society programs. France, led by Charles de Gaulle, noticed. They started demanding gold for dollars. Other countries followed. The US didn't have enough gold to meet redemption demands. So in 1971, Nixon closed the gold window. The dollar became pure fiat, and for the next decade, gold surged 24x. That sequence is instructive. Deficits, currency debasement, institutional recognition, gold accumulation, price explosion. We're watching a similar sequence unfold now. The deficits are larger, the debt is higher, and central banks are accumulating gold at rates that echo the pre-1971 period. The pattern is rhyming. Here's the positioning framework. And I'm not giving advice. I'm outlining how informed institutions are thinking. First, gold as a portfolio hedge. Not speculation, not a trade, a structural allocation. Between 5% and 15% of a portfolio, depending on risk tolerance. The goal isn't to get rich, it's to preserve purchasing power if currency trust declines. Second, physical versus paper. Physical gold has no counterparty risk. ETFs are convenient, but carry systemic risk. In a true crisis, delivery could be an issue. Informed buyers prioritize physical. Third, silver as a leveraged play. If gold moves 50%, silver often moves 100% due to its smaller market and dual demand, but with higher volatility. Fourth, patience. This isn't a quick trade. This is a multi-year structural shift. The people who benefit are those who position and hold through volatility. Here's what concerns me most. The market is treating gold's rise as a temporary spike. It'll correct. It always does. But when I look at the drivers, central bank buying, fiscal deficits, currency debasement, geopolitical fragmentation, none of those are temporary. They're structural. They're accelerating. And they're not going to reverse without major policy changes that I don't see coming. So if the drivers are structural, why would the price response be temporary? It won't. This is the beginning of a repricing of monetary risk, and that repricing has years to run. Let me give you the question that keeps me up at night. If central banks, the institutions that control currency policy, are converting their own paper into gold at record rates, what do they know that the public doesn't? They have access to data we don't see. They have forecasting models. They understand debt trajectories, and they're hedging aggressively. That's not a signal to ignore. That's a signal to study. And when I study it, I see the same pattern that preceded every major gold bull market: institutional accumulation, currency debasement, system stress, and price acceleration. Here's my final thought. Gold at $3,500 feels expensive if you think in nominal terms. But if you think in terms of currency debasement, debt accumulation, and monetary system stress, it's still early. The 1970s saw gold go from $35 to $850. That's 24x. If this cycle mirrors that magnitude, and the fundamentals suggest it could be larger, we're talking about $5,000 to $8,000 as realistic targets over the next several years. Not because gold is special, because currencies are losing trust. And when trust erodes, alternatives get repriced. That's not speculation, that's pattern recognition. So here's my question. Do you see the pattern? Do you see central banks accumulating? Do you see deficits expanding? Do you see currency trust declining? Because if you do, you understand. This isn't a gold rally. This is a monetary system shift. And the people who recognize it early, who position accordingly, who hold through volatility, they'll preserve wealth. Everyone else will watch purchasing power erode and wonder what happened. Don't be everyone else. If you want to follow this as it unfolds, subscribe. Because gold's move to $3,500 is just one chapter. The drivers behind it, the fiscal trajectory, the monetary policy, the geopolitical shifts, all of that is still developing. And understanding where we are in the pattern matters. The people who see stage 3 acceleration position before stage 4 dislocation. Everyone else arrives too late. The choice is yours, but the pattern is clear, and the clock is ticking.